A recent action by China should frighten every American. U.S. Treasury bonds totaling $9.6 billion. Sold, abandoned, and dumped on the market in just 1 month. Furthermore, this is not a haphazard sell-off. The Chinese Treasury is liquidating for the 11th consecutive month. Beijing has been silently withdrawing from the American debt for 9 months in a row. They currently have $759 billion in holdings. That may seem like a large amount, but then you understand something crucial. Since February 2009, this level has been the lowest. We are discussing a 16-year low. When China last held this small amount of U.S. debt, the world financial system was on fire and Lehman Brothers had just failed. However, nobody in Washington wants you to be aware of this. China is purchasing gold at a rate that is keeping central bankers worldwide awake while they are dumping dollars. It's not limited to China either. Like the last lifeboat on the Titanic, the G7 countries are really rushing to Shanghai and battling for actual gold and silver. A market cycle is not what you are seeing. This is the dollar empire's methodical deconstruction, and it's happening more quickly than anyone is willing to acknowledge. Allow me to explain why China's actions regarding bonds are important. Because financial markets aren't the only thing at play here. This concerns the worth of each dollar in your pocket, the mortgage interest rate, and the cost of everything from groceries to gas. China is not an ordinary creditor. They possess the second largest amount of U.S. debt abroad. The effects of their sales are felt across the board in the U.S. economy. The following calculation should keep Treasury Secretary Scott Bessent up at night. Just this year, the U.S. has to refinance approximately $8 trillion worth of federal obligations. $8 trillion, it's not a typo. Furthermore, in order to pay for our deficit spending, we must issue at least $2 trillion in additional debt. Thus, we require 10 trillion purchasers. Additionally, our second largest customer is leaving the store. However, the bond sales are only the prelude. The true story is what China is doing with that money. It won't be placed beneath a mattress. They are changing dollars into gold, the one commodity that has been used as money for 5,000 years. Following a 6-month hiatus, China's central bank formally started buying gold again in November 2024. November 2025 saw 5 tons, and January 2025 saw 5 more. That may not seem like much, you may be thinking, and since these are official recorded purchases, you have every right to be dubious. According to intelligence specialists, China actually purchases 10-15 times more gold than it discloses to the public. Give that some thought. They may be purchasing 50 or 75 tons, even though they are reporting 5 tons. Furthermore, this tendency is not unique to China. The world's central banks recently finished their 15th year of net gold purchases. They bought more than 1,000 tons in 2024 alone for the 3rd consecutive year. 473 tons annually was the historical average. We are witnessing more than twice that. This conduct is not typical. This is a buildup of panic. This is the process that is sending the dollar into a downward spiral. U.S. Treasury bonds that are sold by China don't simply vanish. They must be purchased by someone. However, there is an issue. There aren't enough willing purchasers at the current interest rates. Yields must therefore increase. Everyone's borrowing costs, including those of the U.S. government, increase with increasing yields. We made interest payments on our national debt totaling more than $1 trillion. Every percentage point that rates increased last year increased that bill by hundreds of billions. It is a self-sustaining feedback loop. Higher rates result from more sales. Larger deficits are produced by higher rates. More borrowing is necessary for larger deficits. More borrowing results in more sales. Empires die like this, with a balance sheet rather than a big boom. However, something darker is going on underneath the surface. These bonds are not being sold at random by China. Major liquidations frequently take place during overnight sessions while U.S. markets are closed, according to market statistics. These aren't your typical investment choices. The best price and maximum liquidity are what typical sellers seek. This appears to be calculated market manipulation intended to minimize China's own losses while maximizing harm to U.S. bond markets. In disguise as portfolio management, it's financial warfare. In the meantime, the purchasing of gold provides us with all the information we require regarding China's long-term strategy. In 2024, Poland took the lead. increasing reserves by 90 tons. 73 tons were purchased by India. At an unprecedented rate, Kazakhstan, Turkey, and Hungary are all establishing strategic gold positions, but the elephant in the room is China. This is what the majority of analysts are unaware of. China most likely owns less than half of the gold that is reportedly in its possession. In addition to official central bank statistics, the State Administration for Foreign Exchange maintains parallel gold stockpiles. Despite only disclosing 1.2 tons of gold to the public, Goldman Sachs analysts think China purchased 15 tons in recent months. That is over 10 times the official amount. Allow me to put this in context. Every 100 tons of gold costs roughly $13.5 billion at $4,200 per ounce. China has more than $3 trillion in foreign exchange reserves. Even if they only put 10% of their money into gold, it would be $300 billion. That is sufficient to purchase more than 2,200 tons at present pricing. That amounts to about 2/3 of the world's yearly mine production. Imagine attempting to withstand that level of purchasing pressure. The cost would soar rather than merely increase. This is when things start to get interesting. For this move, the Shanghai Gold Exchange is turning into the starting point. Over 600 tons of gold were taken out of Shanghai vaults in October 2025, with the majority going to London. Take a moment to consider that. Chinese gold stockpiles are being actually depleted by Western investors for physical delivery. Here's the catch, though. The prices of all those Shanghai contracts are expressed in yuan currency rather than US dollars. Therefore, Western purchasers are using Chinese currency when they rush for Chinese gold. They are attempting to defend themselves against dollar devaluation while advancing de-dollarization. The irony verges on poetry. This brings to mind the events of the early 1970s, but there is one significant distinction that alters everything. Charles de Gaulle, the president of France at the time, demanded gold for dollars, challenging the currency system. The power to print money and purchase actual assets from other countries is what he referred to as America's outrageous privilege. Nixon had no option by August 1971, since so many nations were demanding gold in exchange for their currencies. He shut the window made of gold. Overnight, the Bretton Woods system fell apart. The dollar, however, endured. Why? Since there was no other option. There was a collapse in the Soviet economy. After the war, Europe was rebuilding. China's agricultural society remained closed. This period is different for the following reasons. In 1971, China is not France. For the majority of nations on the planet, China is their biggest trading partner, their largest manufacturer, and their second largest economy. 1.4 billion people and dozens of allies may instantly access China's financial infrastructure. In 2024, the cross-border interbank payment system, China's version of SWIFT, processed 24.5 trillion transactions. That represents a 43% increase from 2023. Currently, the system links 4,900 banks in 150 different countries. Nearly all of the $244.8 billion in bilateral trade between China and Russia in 2024 took place in yuan and rubles. India is paying rupees for Russian oil. Currency swap agreements exist between China and Brazil. This is not a menace from the far future. There is already an alternate method of payment. It's working already. The dollar is already losing market share to it. In 2024, Asian businesses issued more bonds denominated in euros, accounting for 23% of all foreign currency borrowing. That amounts to $86 billion in funding that completely avoids the dollar system. However, the buildup of gold sets this challenge to dollar hegemony apart from all others. Thousands of tons of actual gold that cannot be frozen, confiscated, or devalued by political order are being amassed by China, Russia, and the other BRICS countries. Additionally, the actual markets for precious metals are beginning to scream warnings that the mainstream media refuses to heed. Silver stocks in Shanghai recently fell to a 10-year low. Lease rates in London reached a peak of over 30% in October before leveling off at roughly 5 to 6%. That only occurs when there is a genuine physical shortage rather than when the price of the paper is manipulated. Due to backwardation, the price of immediate delivery is higher than that of future delivery on the Shanghai silver market. That would be like to paying more for same-day shipment when standard delivery ought to be less expensive. It only occurs when individuals are in dire need of actual metal at the moment. This is the portion that every American strategist should be afraid of. Silver is listed as a key mineral for national security in the United States. We need it for solar panels, electric cars, defense uses, and pretty much everything else needed for the green energy transformation that both political parties say they support. However, the majority of our silver refining has been outsourced to China. Guess who is in charge of the spigot when supplies become scarce? The next stage is starting to become apparent. The diversification of foreign central banks away from dollar assets will continue. It's not because they despise America, but rather because having too many dollars has turned into a threat to national security. See what transpired with Russia's frozen deposits worth $300 billion. All of the world's central bankers took notes. It was an obvious message. It is possible to weaponize dollar reserves. Poland's gold reserves now account for 17% of its overall foreign reserves. India brought back 100 tons of gold from the United Kingdom. What does it say if Poland, a NATO ally, doesn't believe in dollar stability? There is a foreseeable pattern to the trajectory from here. When enough organizations demand physical delivery at the same time, the markets for paper precious metals will collapse. The backwardation of Shanghai silver is only the first step. We are discussing a repricing event that casts 1980 in a mild light. When the Hunt brothers acquired over 200 million ounces of silver in 1980, the price increased from $6 to $49. Sovereign nations are currently vying for supply in a market that has been in deficit for 7 years running. Approximately 47 million ounces of registered silver are available for delivery from the COMEX. Over 700 million ounces are needed annually for industrial purposes alone. Physical pricing and futures prices will be totally unrelated when the paper market collapses. COMEX might cost $30 in silver, but actual delivery costs $80 from dealers. The timing for the U.S. couldn't be more dire. During this period of economic expansion, we have a $1.8 trillion imbalance. Last year, interest payments surpassed $1 trillion, surpassing defense expenditures. That burden is increased by hundreds of billions for every percentage point that borrowing costs rise. This produces a feedback loop in which the diversification of one central bank inspires others to do the same. When the music stops, no central banker wants to be the last person with currency. Investment banks are already setting themselves up for future developments. Goldman Sachs increased its target price for gold to $4,500 an ounce. JP Morgan is discussing $4,600. You know something fundamental has changed when Wall Street begins setting the price of gold at such levels. Industry contacts claim that physical silver premiums in Asia are skyrocketing. For 1,000-ounce bars, we're seeing premiums of $5 to $8 over the spot price. Never before. To relieve the pressure that caused leasing rates to rise above 30%, China exported a record 660 tons of silver in October 2025. Despite controlling the majority of the world's refining, they are compelled to export strategic stocks in order to keep the London market from collapsing. Furthermore, the timing of China's treasury sales is not random. Geopolitical concerns or U.S. policy announcements frequently coincide with significant selling sessions. Treasury yields increased by 50 basis points in a single week following Trump's announcement of Liberation Day tariffs in April 2025. Organic market forces weren't involved. The purpose of that coordinated selling was to convey a message. The unipolar monetary system is coming to an end. The world has been operating on pure fiat dollars, supported solely by military might and inertia, for the past 50 years since Nixon closed the gold window. The brick-and-mortar payment system is no longer merely theoretical. In 2025, Indonesia became the 10th full member. 13 additional countries agreed to become partners. That coalition accounts for about 25% of the world's GDP and more than half of the world's population. They have no intention of changing the dollar system. It is being replaced. This isn't coming from a single rival state. In contrast to earlier threats to U.S. monetary hegemony, it is the result of several major economies working together in concert. Energy comes from Russia, Manufacturing is done in China, India offers services, commodities are supplied by Brazil, mineral resources are available in South Africa. They have what they need to operate a parallel global economy. By increasing financing in local currencies, the new development bank established by BRICS in 2014 has helped member states avoid the dangers associated with debt denominated in dollars. The NDB promotes financial sovereignty in contrast to the IMF, which enforces stringent austerity requirements. Countries weary of dollar domination and Western financial control are finding it more and more alluring. The question is not whether this shift will take place. How quickly and chaotically it will happen is the question. Physical market shortages, alternative payment methods, record central bank gold purchases, and China's treasury dumps are all related. They are all a part of the same enormous movement away from reliance on the currency. This kind of monetary regime shift was last observed in 1971 with the fall of Bretton Woods. Prior to it, the traditional gold standard was abolished in 1914. Perhaps once every 100 years these changes take place. Early detection allows the smart money to adjust its positioning. The question is whether you'll be among the smart money crowd or the late waking bunch. The text is inscribed in and on the wall.